Money at Work, continuing financial education series brought to you by Millionaire Mindset Life. Today's episode centers around interest rate versus interest volume. What's the difference? Why does it matter? And how much are you really paying the bank? When it comes to the mortgage, many people think if they get the lowest possible interest rate, they've won. And while it's definitely a good thing, the whole idea is pretty deceptive. Regardless of your interest rate, you'll still be shelling out tens, if not hundreds of thousands of dollars in interest over the course of the mortgage. And the tricky part is you'll be paying a huge portion of that interest in the first 7 to 10 years. If that's news to you, you're not alone. What we're going to explore is the difference between interest rate and interest volume, how much you'll actually be paying the bank each month, and how to save tens, if not even hundreds of thousands of dollars in interest instead of that money going to the bank. Have you ever wondered why banks are in the business of lending money? The answer is very simple. It's interest. Interest is the bank's bread and butter. They make a massive chunk of their profits by charging people interest on their mortgage. So the lower your interest rate, the better, right? Well, yes, but unfortunately it's more complicated than that. As it turns out, not all interest is created equal. A lower interest rate certainly helps make your principal mortgage payments more manageable, but when you sign up for that deal with the bank, they don't tell you the whole story. What they don't tell you is how much of your monthly mortgage payment will actually be going towards paying them back in the form of interest. And spoiler alert, if you're not sure, it's a lot of money. So interest rate versus interest volume, what's the difference? In the 1970s, banks figured out that most homeowners are only going to stay in their newly purchased home for around 7 years on the average. So to ensure they got the most out of every loan, they created what's called front-end loaded mortgages. When a mortgage is front-end loaded, as they all are now, it means that a majority of interest that you owe to the bank is tacked on to the first 7 to 10 years of that mortgage. It's a clever little strategy in how banks make sure they get their fair share in case you decide to leave your new home within that time frame. But what exactly does that mean for you? Well, even if you have a low interest rate, the actual amount of interest that you pay each month can take up a huge portion of your total monthly payment. The amount is called interest volume. Interest payments are calculated based on how much you actually owe the bank. So the more you owe, the more your interest volume will be. It's not uncommon for interest volume to take up as much as 60+% of your monthly mortgage payment. So let's take an example. That means if your mortgage payment's $2,000 a month, you'd be shelling out up to $1,400 in interest. That money's going straight to the bank. And then by the end of your mortgage, you could be paying hundreds of thousands of dollars in interest, or really interest in this case is nothing more than the bank's profit. So what do you really pay the bank? Let's say that you take out a 30-year mortgage, and let's say you borrow $300,000, which is the less than the median home price in this country, and let's say that you get a rock bottom interest rate of 3%, which is not available now. So $300,000, 30-year mortgage at 3%. On the surface, that looks like a great deal, but when it's all said and done, you'll end up paying $455,000 in change in total over that 30-year period. With just a little bit of math, that means that you'll be giving away $155,000 plus of your hard-earned money to the bank in the form of interest payments that's just lining their pocket. That's over 50% of what the house costs in interest alone. But believe it or not, that's getting off easy. By charging people interest on their mortgage, banks regularly take in 75+% of total mortgage cost. These loans not only cost families hundreds of thousands of extra dollars, but they also keep them locked in for decades, often robbing them of the opportunity to build real, life-changing wealth for themselves. So naturally, this question comes up. How can you save the money instead of sending it to the bank? If your interest payments are calculated based on how much you still owe the bank, then the best way to reduce your interest is to pay your debt off as quickly as possible. Many people figure this out and think, I'll just be super frugal, cut out any needless spending. But there's one big problem with that idea, and that is consistency. Income and expenses are dynamic. The flow of money in and out of your account changes all the time. Your car may need new tires. You can take your family on vacation. Unexpected medical expenses could come up. So basically life happens, right? Tracking these changes, understanding their long-term financial impact, and updating your strategy as you go would quickly turn into at least a part-time job. And most people already work 40 or more hours per week. They have families, they have mouths to feed, and they have a mountain of other responsibilities on their shoulders. Plus, to save a significant amount of interest and shave years off your mortgage, you would have to be incredibly disciplined and save and repurpose idle money in your accounts for a very long time. We're talking several years. So what we really found out that works best for people and our clients who get the best overall results with the most monetary and the most time savings is when they have proper education to discover the knowledge of what to do and why to do it. And then along with that, the execution, which is how to get it done. This also means that we're understanding how to place and use the power of superior technology to create the most linear equations from where we are right now to where we want to be financially speaking, mapping out the shortest, most efficient path possible. We have webinars, we have one-on-one education for this. You need to understand how much you're sending the bank, and then you need to understand how to reroute that, schedule money that's scheduled to go to the bank back to your financial plan, and use that as seed money for assets. Don't be the bank's best customer. That's the worst plan for you. Millionaire Mindset Life, stretch your thinking, create your vision, and achieve.